On average, flips can make us 40 to 50% returns within a 6-month window. That's a massive return that you can't find in many other asset classes inside real estate. But just like any investment, with that big of a return, there's an inherent amount of risk. And it is all about the underwriting to protect your risk when you get into flipping. It's a high risk, high reward, but the risk can also be detrimental. What's going on, guys? It is James Dainard, and we are back on BiggerPockets YouTube channel. And today we're going to talk about how to underwrite your next flip deal in 2024. So before we get into the underwriting in 2024, let's dive into the basics of flipping. What is flipping? Flipping is when an investor targets a property below market value. They then improve the value with a strategic rehab plan. That could be a cosmetic update where they're doing cabinets, flooring, doors, and simple updates, or it can be a step further where the investor is creating additional space. They can be adding bedrooms, adding bathrooms, finishing basements. But regardless, the plan then improves the value. So why do people even flip properties in general? As we hear, investors can make these massive returns and build wealth through buying properties and keeping them. And trust me, I believe that. We have nearly 1,000 doors in the Pacific Northwest. We have built wealth by keeping our properties. But the purpose of flipping is to create more cash so that then you can reinvest into other types of properties. On average, flips can make us 40 to 50% returns within a 6-month window. That's nearly 100% return annually. That's a massive return that you can't find in many other asset classes inside real estate. But just like any investment, with that big of a return, there's an inherent amount of risk. And it is all about the underwriting to protect your risk when you get into flipping. It's a high risk, high reward, but the risk can also be detrimental. So as interest rates rose in 2023, we had to underwrite properties a lot differently. We knew that we could be in a declining market. The rates were going up. That can mean values were going down. As we underwrote properties, we were factoring in depreciations in our exits rather than appreciation like we saw in 2022. And 2023 was a very risky market, but it was very profitable as well. What we did see is as the market changed, we were getting better buys. There was less investors in the game. There was not as much appreciation. There was a lot of fear in the market. So what it did is allowed us to purchase at a much bigger discount. When we were underwriting in 2023, we were factoring in for depreciation. We were factoring in for longer hold times. The market was moving a lot slower. In addition to, construction was still really high and unknown, so we were padding all of our pro formas. This allowed us to reduce risk in a declining market and still make gains in 2023. So the underwriting procedures we put in 2023, a riskier market, worked for us. We made profit, we were safe on our purchasing, and the margins got bigger. It was a great year, even though we were in a declining market. But as we go into 2024, the forecast is a little bit different. 2023, we thought the market was maybe coming down, but in 2024, they're saying that the Fed could cut rates up to 6 times. Now, that is not a guarantee, and we don't know if that's going to happen. But by knowing that this information is out there, it might make us a little bit more bullish in 2024 than we were in 2023. As flippers or investors, we have to change how we buy in each market cycle in each year. Risks go up, they come down. And it's important to implement these risks into your pro forma so you can protect your investment. So we're going to jump into our core steps for 2024 as we look to underwrite our next flip property. The first thing we're doing before we even dig into the property is we have to update our buy box. As investors, the way we can protect ourselves in a high risk investment is to make sure that we have clarity in what we're buying. A lot of times when I'm taking a loss on a property or it didn't quite perform, it's because I got outside my buy box. It looked like a great deal, but I wasn't sticking to what I was really good at. As flippers, there's all different types of properties out there, and specific types of properties are going to work better for some investors and worse for others. So we're going to dive right now into a live underwriting session where I'm looking at a deal right now. This is true. Am I going to buy it or not? It's a property that was just sent to me from a wholesaler. I'm going to break it down and we're going to dig through on how I'm protecting myself in 2024. This property is located in Edmonds, Washington, which is about 20 minutes north of downtown Seattle. It's a great market, good schools, great for resale, fairly safe area to live in. I like this area in general. The purchase price on this property is $780,000. The wholesaler has this for $175,000 as the fix-up, and they have a target value of $1.3 million. They provided me with a link to the comps, and then they give me a breakdown of the square footage and what they think needs to be done. So the first thing we do is we dive into the location, and it's really important for 2024 because the buyer demand has changed. If you have something that like a bad neighbor or a busier road, not only can it reduce the value, it's going to be a lot less buyers in the market looking for that kind of property or that are okay with that negative defect. And it could add serious hold times, 2-3 months longer than what a normal flip could take you. So digging into the location is really important. So I took this property's address and the first thing I always do is go into the street view. What does the neighbor look like? So we're in a pretty normal neighborhood, a cul-de-sac at the end. There's some nice big houses around it, some renovations. It looks like they're building a house right over here. But one of the things I'm noticing is we don't have a busy road. We don't have any major power lines going on. The neighbors all look clean. So I feel overall good about the street. If I feel good about it, the next buyer could also feel good about it. So the location's looking good. There's nothing in there in general that is going to kind of scare me from this deal. I like the area. I like the neighborhood. The street has all good neighbors, no negative impact. So as you go into 2024, double check those locations. Is there anything negative that's going to drag out your sale? So once we dug into the location to make sure there was no deal breakers, then we want to dig into the asset. What is the property? What is the potential value? What is the square footage, the bedrooms, the bathrooms? Is there unfinished square footage in the space? What is the zoning behind this property? So what we always do is we go back to the wholesaler's email and we look at what they told us. Wholesaler told us it was a 2,200 square foot property with a 1-car garage and a carport. The current bed bath count was 6 bedrooms, 2 bath. The ARV bed count was 4 bedrooms, 2.5 baths. So they did make an adjustment. They're saying we need to add a half bathroom. And it was built in 1956 with a lot size of about a 1/4 acre. As the investor, I need to verify this information. So what we use to evaluate the asset is we use the Northwest MLS because we're licensed real estate. If you're not a licensed real estate broker, that is okay, because as a flipper, you're supposed to build a huge bench. You're supposed to get your team behind you. One of those people in your teams needs to be a real estate professional. You always need to have a go-to. This broker can either pull you your tax information or you can go to public websites. Almost every county and every city has a public search site to where you can input the information and they're going to give you the tax record information. In addition to, you can use software sites like Property Radar to where they will give you the tax information. The information is always available for free. Go to your public assessor website, put in the address, you'll get the same information. So we're using our tax record, and what we want to look at is there's core things that we're looking for. First thing that we want to look at is what is the lot size. This is about a 1/4 acre. So when I go looking for my comparables, I want to find properties on the same size lot. I don't want to use properties that have double the same size lot or triple. That's going to be worth more. Or as I'm evaluating properties, if they have half the size lot and that's the only comparables I can find, I need to make some adjustments. Land is a big deal, especially after the pandemic. People want to spend their time outside. This will pay you a premium sometimes. So in this property, we have a 1/4 acre lot. It's a pretty large property. It's going to be good for resale. We have a 2,200 square foot house in a family-friendly neighborhood. So I like that it's got a yard that's workable for that next potential buyer. The next thing I'm looking at is what is the year built. The reason I look at the year built is when I'm establishing my comparables, I try to stay within about a 20-year buffer on either side. So this property was built in 1956. I'm going to be pulling comparables up to about 1979 and to about 1930. It's going to give me a window of time. Typically, these are going to be very similar architecture that's going to be around the same type of layouts. In addition to, the reason I like to dig into the year built is based on the year built and the condition. This tells me as a flipper what kind of mechanicals are in the property. If I'm seeing a fixer property built in the 1950s or 60s, I can assume that I have to spend a lot more money on this property, rewiring it, replumbing it, adding in new HVAC systems. That can extend my timelines. So when we get to the performa, by looking at the year built, it's going to tell me what is my timelines to fix this property. Remember, I'm trying to make a 40% return in a 6-month period. If this deal is going to 9 months, I might need to make my return expectation 50 to 60% so I can still make that same annualized return. So after we've gone through the tax record and we know what we're working with, we know what our square footage is, we know what our bedroom bath count is, now we need to look through the property photos. As you can see, I dig into the information before I even get to the photos because I want to know these square footages. As I go through these photos, based on the square footages, I can kind of allocate a rehab cost as I'm going through them. If I skip the tax record and I go right to the photos, I don't know if it's a 1,500 square foot house, it could be 3,000 square foot house, house, that's going to throw all my mathematical numbers off. So I know I have a 2,200 square foot house. So as I go through the photos, I can see right here that it just needs a lot of work. We got a 1-car garage. Looks like there's a carport here that's kind of beat up. But I also see that we can add in another garage space. It's just going to take a little bit of money. So I can get back to a 2-car garage. As we're going through these photos, I see the landscaping needs a full overhaul. That's telling me I probably need to have 15 to 20 grand in my landscaping budget, even just for a light flip. Okay, and as we get in, we can kind of see that 1950s feel to it. It's got, this is a cool brick fireplace, but there's a lot of garbage in this property. That means I'm going to need to do a lot of trash out. It doesn't look like many things have been updated over time here. That's telling me as a flipper, I'm going to have to do a full renovation on this property to get it to highest and best use. So typically, as I'm looking through a fixer property, I can look at this and go, if I got to do the mechanicals, I need to do the electrical, I need to do the plumbing, that's going to cost me about $90 to $100 a foot as I go through on that. That means at a 2,100 square foot house, my budget's going to be about $200,000 to $210,000. The wholesaler said $175. And so those are numbers I'm going to need to adjust. So as we go through, there's actually some good things about it. Looks like the downstairs bathroom was a little bit updated, but we just have a very deferred maintenance house. A lot of things need to be done. I'm looking for what I can keep and not keep as I go through the comparables. I mean, one thing that I am seeing is we do have some vinyl windows in here. That's going to save me about $5,000 to $10,000 off my budget, depending on how many need to be done. That's a lot of garbage. So as I'm going through this, I'm also looking not just at the condition, I'm looking at the spaces, right? Because I'm going to pull my comparables. I want to see the similar types of spaces in there. We saw the living room was big. I'm seeing the kitchen is a galley, all closed off. So when I look at my comparables, do I need to open that kitchen? How big do I make that kitchen? That's going to allocate budget. Photos will tell you a lot of stories. In addition to the tax record backs them up with the price per square foot. So as we can see, it's got a nice big oversized bathroom here. And as a flipper, guys, I'm looking at this space and I know this is oversized. So what this tells me is this looks like about a 12 by 8 bathroom. I'm going to be able to cut into this and split 2 baths in if I need to add the value. So as we go through, we can kind of see it's a normal split level house. 3 bedrooms, 1 bath up, 2 to 3 bedrooms in the basement, 1 bath down. Pretty straightforward layout. But I did see that it just needs a massive amount of work, right? So we're going to need to put that about $100 a square foot on here. This deck's toast. It's going to need a full revamp. But the next step when we're evaluating a flip is we have to dig into the comparables. Do I need to take it to that next level, $200 a foot? Can I get my rehab down to $150 a foot by scaling it back? And this is what the comps are going to do. So to pull comparables to value the price, we use the Northwest MLS because we're licensed real estate brokers. And again, if you're not a licensed real estate broker, that is okay, but get that person on your team. Every flipper needs a broker on their team. They can pull you the CMA. They can help you with the eval. It will help you out down the road. If you don't have that person on your team, you can use public websites, Zillow, Realtor.com, or you can use stuff like Property Radar that will give you all the information and pull some of the comparables out for you. But no matter what, as a flipper, you need to evaluate how you want to pull your comparables. So the range that I stick in when I'm looking at comparables at any flip properties, I typically stay within a quarter mile to a half mile. I want to see what's going on in the immediate area. So if you're in rural areas, we go up to 2 to 5 miles out. Properties are on larger lots. There's less data points. We got to go further, and it doesn't affect that end buyer as much. They're used to kind of driving in between places. So you want to always evaluate where you are, what distance can you go. So as I'm looking through these data points, this is a great comp for me to find. It's on a busier road, that's worth less. It's not fully renovated. It's got old doors. It hasn't been fully turned. In addition to, it doesn't have that primary bath, and it's sold for $1.2 million. Now remember, I'm looking at buying this property for $765,000. So there's my spread. It's starting to make sense. If I do a full renovation, I should be worth at least 1.25 to 1.275 by not being on the busy road and not accounting for the full renovation. And this is how we like to underwrite in 2023 and 2024. As flippers, I never want to go to the top number. That outlier comp that's the highest price, we've been kind of throwing them off the data points. Where we've done well in transitionary markets is we over budget and we still anticipate the same low sale. So as I'm looking at this property and I want to make sure that I'm going to get that 1.25 to 1.275 number, I can give my buyers better value. They're getting a home not on a busy road. We're going to give it a full renovation. And if I want to add an additional kicker, I can still put in that primary bath to really hedge the risk in a deal. That is what is so important in evaluating deals in 2024. As we don't know what's going to happen in the market, we need to be prepared. The rates could go down, they could stay flat. If they stay flat, we'll probably see a very consistent market. If they go down, we could see a rise, but I'm not going to bank on that as a flipper. And that's why I can make this a smart investment buy. So after we analyze the property, we now need to figure out, is this profitable? We're going to utilize the BiggerPockets flip calculator, and it's going to tell us whether it's hitting my buy box or not. So the first thing you want to do is when you log on to BiggerPockets.com, you're going to go look to the flip calculator. Once you get there, you want to enter in the after repaired value, which we established a value of 1.275. I took the $1.2 million comp, I added in 5% for the not being on a busy road, and we gave it another $25,000 in value for being about $100,000 more in rehabbed. So the desired profit that I'm looking for is going to be about $100,000. If I want to make a 50% return on my investment, I need to make about $100,000 in profit. So I'm going to enter in the desired profits, and then we're going to enter in our closing costs for our purchasing. Typically, on average, we're going to pay about 1% in all closing costs, which is on the high side, but in 2024, we want to kind of pad that up. So we're going to put in about $7,000 in closing costs, and then we're going to enter our repair cost, about $100 a square foot, 2,100 square foot house. We're going to put it in about $200,000 of repair costs because I'm going to take some things off for the good windows. The next thing we need to do is calculate our hold times. How do we figure that out? The best thing you can do is talk to your lender and get a quote on your rate. Then you can calculate it off your balance. Our lender, Intrust Funding, who finances all of our flips in the Pacific Northwest, will give us a construction loan. They require a 15 to 20% down payment of the total project costs. They take our purchase price of $780. They put the $200,000 in as a rehab component, and we bring 15 to 20% down on the property, and they finance us all of our construction loans. That means we're gonna have a loan balance of about $800,000. At a 1% interest per month, that means our hold costs are gonna be about $8,000 a month. After we calculated our debt costs and put it in, then we have to figure out how long are we gonna hold the property for. So in 2024, like we did in 2023, is we're adding a little bit more time. We're accounting for that cost. The end of 2022, when the rates skyrocketed up, it caused the market to slow down. That meant we had to carry the properties longer. That can erode your profit. So if you want to be safe in 2024, add a couple months of hold times on there so you know you can be safe. So if I'm trying to be completely safe on this property as I look at underwriting, I thought this property was going to take about 9 months to renovate and sell the property. If I put it at 12, it gives me a lot bigger padding in my pro forma to offset those costs. It's a way to reduce your risk in a high risk environment. So after you enter in your debt information, you need to get the other cost, which is the cost to sell. You need to enter in your real estate commissions. Typically, on average, it costs us about 6% in the Pacific Northwest to sell that property. We pay 3% to our Dainard broker because they help us with the design work and they help our projects keep moving forward. On average, our brokers on the buying side are going to charge 2.5% to 3%, or the typical cost. I always put it at the high side because I want to have more room if I need to negotiate later down the road if the margin gets low. The more cost you put into your pro forma, the juicier it is, the more you can take on risk. So if you're getting a deal from your broker because you're an investor who does a lot of volume and they're giving you a discount, still put in those higher commissions because it will pad it in. That gives you more room in the deal. Our typical sale closing cost in the Pacific Northwest are going to be about 2.5%. So at 1.275 at 2.5%, that's going to be $32,000 in cost. Once I've entered in all my sale costs, my debt costs, then voila. The BiggerPockets calculator calculates the profitability for you. So what this is saying right now, after calculating all costs with my desired profit of $100,000, it's saying that my max allowable offer is $762,000. They're at $780 right now, so we're not that far off. So it's a close deal. So things that we want to do as we look at evaluating, we don't want to pass. Can we get our rehab down? There were some things that we looked at. We saw some windows. There might be some ways to get this cost down to $190,000. That's going to get me really close to this deal. In addition to, we have this at about 12 months hold times. If we can get 2 months off, that puts another $16,000 in the deal. But it makes me comfortable to move forward on this property because the margin is there. There's enough padding into it. As we've underwrote the property, we underwrote for the highest possible rehab. As we looked at the values, we're going to have a fully renovated property with an additional bathroom on a better lot, and we're being very conservative at the 1.275 numbers. There's a lot of room on that as well. In addition to, I haven't given myself any discounts for agent fees in there. So again, we have $76,000 that I can negotiate with my team if I need to get the margin down. There's lots of padding throughout this pro forma. As you go into 2024, pad your pro forma, add in extra debt costs, add in a little bit heavier rehabs, stick to your margins, know what returns you expect, and I can go into a deal in 2024 feeling very comfortable. So as we pad the pro forma, it reduces the risk. We would have to see this property drop another 10% in value for us to lose money on this property. And the upside could be there in 6 to 9 months when rates start cutting. So we are going to move forward on this deal. It's hitting our buy box. We know what it is. We have a lot of padding, and we can feel very good about moving forward in 2024. So thanks for watching our video on how to underwrite your next flip in 2024. If you liked the video, make sure you tell us, like and subscribe below. And for more information about flipping properties, check us out on Instagram at jdainflips or jamesdainard.com.